In this video, we're going to be looking at document number 2. On document number 2, the subject is various matters. What I'd like from you candidates is that if you have not watched document 1 videos, please start by watching document 1. Document 1 video is made up of 2 videos. It is a video that discusses the first 2 line items that are discussed in document 1, and then the other one, which is a second video, it covers the subsequent details or documents that are in document 1, or line items that are in document 1, which is obviously going to be your 3 up until 4. So please start by watching those videos before you can move with me to look at document number 2. So what is also important for you to know before we go and read document number 2, I am not going to be reading document number 2 in details. If you have not read document number 2, I'd like to request you that you first read document number 2 alone. Then it will be easy for you to move along with me as I analyze document number 2 with you and provide you guidance in terms of what you were supposed to be looking at during the pre-release period. So we are now in document number 2. So when you're looking at document number 2, this is an email from the CFO, which is Charles. Then it comes into the financial analyst. Who is financial analyst? A financial analyst is a candidate, a person that wrote the APC in 2020. Now, what is important about this document? In this document, you are triggered for the first time. This video covers our first triggers for this exam. On the first document, it was mainly a background and things that you needed to analyze in order to understand the company. But there was no straight question of the things that you had to assist the CFO with. So a trigger are things where the CFO or your line manager request assistance on, or ask you to say, let us look at it in future. So in that case, it becomes a trigger because it means you need to do a research about that section and understand how are you going to account for that particular line items or that particular documents that you are provided. Now let's just see what is happening here. So this is obviously about various matter. We see that there's matter 1 and matter 2. So the CFO or Charles wanted an assistant from you as a newly appointed financial analyst with few matters. However, on this document, only 2 matters will be discussed, which is matter 1 and matter 2. And what he's saying to you is saying that please look at the 2 matters below, and then the discussion will take place next week. So why is Charles saying the discussion will take place next week? It is because the APC, it is a real life simulated exam. So what does it mean to say it is a real life simulated exam? It means that the way that your line manager will be talking the same way you'll be talking with your line manager in a real life office setup space. So in this case, Charles is saying, we'll discuss this next week because that will be your exam day. Your pre-release normally come halfway through the week, and then on the following week you'll be writing. So it's normally going to be your Wednesday. When I used to write APC back in the days, it used to be a paper that was written on Wednesday. Now that we have gathered this information and we understand what actually is happening here in the first paragraph, let us look at the real matters or the matters that we need to do research on. The first one is about the new external auditors. That simply means that in the current year, they've appointed the new external auditor. If we move down, they recently appointed Lutuli and Associate. The reason for appointment is because they had to rotate the previous auditor in the current year. And then you recall from the background information that the information that we provided for 2020, it was drafts information, it was not audited. Only the previous 2 years, which is 2018 and 2019 financials, were audited, and the current year, which is the year 2020, was not audited. And now from this information, we can understand that the auditors of the information will be Lutuli and Associate, who is obviously the new auditor. And then let's move on the next paragraph and see what is going on. Now, it seems like Charles was on the call with the partner of Lutuli, and the partner of Lutuli had requested that they prepare, or the company that you're working with, which is BK in this case, prepare the schedules of the journal entries relating to the expenditure for Bora plants, the Bora plants produce, as well as avocado inventory. So now, as you look at this information, what are the potentially information? What is the potential information that you might get on the day? So you might be given the journal entries that were processed by the accountants before you came, and then those journal entries will definitely be wrong. I want to bring that to your attention so that you know they will be wrong, and then they will ask you to analyze whether this expense that were capitalized correctly. It might happen some of the item will not be capitalized, that they should be capitalized. In that case, you need to ask that they are capitalized or they should have been capitalized. It might happen that what is capitalized, it should have not been capitalized. What is capitalized, it's capitalized on the incorrect direction. For example, it might happen that something that should be added as income, it's not added, or that should be subtracted as expense, it's not subtracted. What would be that in case? For example, if they got a discount in any of these expenses, that discount then should not form part of the cost, and you find out the discount is added. If it happens that you are given the full fixed asset register, and then you see that the depreciation is added back instead of being subtracted, then you see there's something wrong. So what you're going to get on the day, it's most likely going to be the journal entries. You're going to be given the fixed asset register, or you can be given the general ledger of these items that you will need to analyze. And I can tell you upfront that in order for you to analyze, you need to understand the standards relating to Bora plants produce, as well as avocado inventory. So now what are you going to be doing during the 5 days period? During the 5 days period, you need to go understand what expenditure are capitalized to the Bora plants as per the International Accounting Standard 16, which is property, plant, and equipment. And then the Bora plants produce, you need to understand International Accounting Standard 41, which speaks of the biological asset. And then when you're moving to avocado, you need to understand International Accounting Standard 2, which speaks of inventory. Why you need to understand, and what will be your focus? Your focus will be more on the valuation in terms of what needed to be added, what need not to be added. So you will be more concerned on the initial cost and subsequent cost of these items. You cannot go to the exam without knowing what are the costs that need to be capitalized per International Accounting Standard 16, and what cost that does not need to be capitalized per International Accounting Standard 16. It's the same thing. You need to understand what are the costs or expenditure that need to be capitalized as per International Accounting Standard 41. International Accounting Standard 41 might be new to most of the candidates, meaning to say now you need to understand, go read the standard in terms of what will be initial cost as well as the subsequent costs that are considered to arrive at the value of the Bora plants. Then avocado inventory, you need to understand what are the costs or expenditure that needed to be capitalized and what are the costs that need not to be capitalized in terms of the inventory. So why is that important for you to understand the cost? Because the concern will be more on expenditure related, and the expenditure, it is the cost. Therefore, you do not waste your time trying to read the entire standard. You just need to read what will be important on the day for you to successfully respond to the examiner. This is very clear. You're going to be given something that is not correct on the day, and you will need to pick up what is incorrect and what has been missed. And you have to explain why it is not correct. You cannot only dump the information that you got from the standard, but you have to interpret it in line with the information that you are provided in the background of the company relating to those costs. So now, what was also important when it regard to Meta 1? If we think of Meta 1, there were information that we were provided. So if you're looking at page 7 of the pre-release information, they provided us information relating to the bearer plants produce, and other items. So that means that page 7, where you have information, background information, it would have given you an idea in terms of the company, how they go about capitalizing the expense relating to the bearer plants as well as the bearer plants produce. And then on page 8, on the pre-release information, which is information that we were looking on, you were also told about the applicable policy or accounting policy for the bearer plants as well as the bearer plant produce. So the information that you are given on the information of the day, which is the pre-release which we are looking on, is sufficient for you to understand the accounting treatment and the expenditure that should be included and should not be included on bearer plants. However, for additional information, additional item to be capitalized, you need to understand the standard. So that takes us to the end of Meta 1, which is new external auditor's request. From now, let's summarize what you need to know. You need to understand what's most likely that the ledger or the journals you're going to be provided, they're not going to be correct, and you need to identify what is not right or what have been missed and address that. And the only way you're going to address it is by understanding the information that has been provided to you in the background information relating to bearer plants produce, as well as avocado inventory. In addition to that, you need to understand the standard for International Accounting Standard 16, International Accounting Standard 41, as well as International Accounting Standard 2, to understand the costs that are added in this asset and the costs that are not added in the asset. That's all you needed to focus on, just the cost. It was a cost related question. You didn't have to look for disclosure because the auditors aren't going to be focusing on disclosure, but rather what is generalized to arrive at the figures that we have in the financial statement for this item. So what is also important, it is important for you to understand that one of the item might be asked, two of the item might be asked, or all of the item must be asked, might be asked in the day of the exam. So now we're done looking at Meta 1. Let's see what we have in Meta 2. Meta 2 talks about the new sales agreement. So what is happening with this new sales agreement? Where is it coming from? Who wants to have a sales agreement with BK? They're saying on October 2018, Supreme Brand, which is their customer or the biggest customer from Europe, provided a deal which was quite interesting. And then they said this deal, it will be active on various months. And then there will be pre-agreed price under the normal shipping term. We know the shipping term of the company, that is CIF. CIF, what does it mean? It means that when in Cape Town they deliver the avocado, the risk and reward pass to this European company. However, they need to pay for transportation as well as the insurance. So that is the important thing that you need to understand about the shipping term. It is CIF, and then if they get into this contract, it will still be under CIF. The other important thing that is important is that there will be pre-agreed price. As you see that they're talking about pre-agreed price, you get worried, The reason you're going to get worried is because the rand might, during this contracts, might depreciate. And if it does depreciate, it would affect the revenue that is going to be earned under this contract. And what does it mean? Then there would be potential onerous contracts that will need to be recorded because of now the contract not yielding the benefits for the company. And then if you see here, they're speaking of the various months. We know that European company, there is a specific avocado that they like. And the avocado they like, it's the Hass. We know that Hass, we only harvest in October as well as May. So now as you see that they want this avocado during all this month, the question that you should ask yourself as you read this question, are we going to be able to deliver Hass for the month of April, for the month of June, July, August, and September? If we cannot deliver because there is no harvesting in this month, are we going to have the avocado in the storage that will enable us to be able to deliver the avocado during this month? If it happens that we cannot deliver the first option that they like, are they willing or are they prepared to take the second option of avocado, which is for tear? Then in that case, if they are, then we need to assess we're going to have sufficient stock to deliver the second option of the inventory to Supreme Brands. So those are kind of qualitative questions that you think of as you're looking at this pre-release information. Then you're looking at the units, the number of units. For the first few months, it's a lot. And then as we go down, which is the month where we're producing or harvesting Hass rather, they require very few units. During the times when we actually wouldn't be having Hass or wouldn't be harvesting Hass, they require a lot, which is like 45,900 or 45,900. June, we're not harvesting, they require 53,940. July, we're not harvesting Hass, which is their preferred stock, and they want 58,830. So during the months where Hass is not harvested, they want a lot of it. So which is like something that you think of as responding on a qualitative or strategic side of this question. Should Charles want you to assist with strategic matter regarding to go ahead with this contract. Then we're looking at the committed price. It is quoted in pound, and the prices are not the same. They fluctuate. So you want to understand why the price fluctuating. Can they keep one price during the contract? So those are kind of questions that you want to understand as you're reading this information, whether there is no alternative ways this can be amended. And obviously, the total commitment is number of kg times the committed price. Then when you're looking down, they're saying this contract will result to a purchase of the export sale of plus or minus 60%, and the provision or the supply will be at a slightly discount. What is nice about this contract is that BK will receive 50% upfront payment. That is on 31st of October 2018. That means on the month that they enter into the contract. And then the balance will be received on the 31st October 2019, which will be a year later. So as you look at this information, now you're saying to yourself, you're going to sell at a discount. If you're selling at a discount, are you not going to be running at a loss, or there will be no opportunity cost, as now you're going to be selling it at a discount, but other clients would have given you the full price. So now you're looking at the opportunity cost in terms of going ahead with this contract. They will take plus or minus 60%. Are you going to be able to deliver the stock to other customers that are in Europe as well as the customers that are in South Africa as a result of this order? So those are kind of things that you should pop up in your mind as you read information like this. Am I still, or is BK still going to be able to deliver to the other customer? Because remember, if BK is not able to deliver the stock to other clients, the other clients might drop being a client of BK, meaning there will be a loss in future in terms of not making sales to those clients, because they would have realized that BK is not reputable in terms of delivering avocado to them. And then now they will pay 50%. There will be a payment of 50% upfront payment, so that is more like income received in advance. It will create a liability until we satisfy this one 1,567,299 pound. If we have not satisfied that amount, so we're going to be having a liability until we satisfy that amount. So if it happens that we have satisfied this amount and then post this amount, we still deliver the avocado to them, then there will be an asset. So the asset will be created on the stock that is delivered before receiving the amount, which is the amount that will be received on 31 December 2029. So when you're looking at this one, the number of things that are triggered, just to let you know what you need to understand when it comes to this. So IFRS 15 revenue, you need to understand before you go to this exam. And the reason I'm saying IFRS 15 revenue is triggered, it's because of the fact this is a sale. So since it is a sale, it then triggers IFRS 15, which is revenue from contracts with customers. So you need to understand all the 5 steps that are there, because in the exam question, you will not be able to be successfully in this question if you do not understand IFRS 2. Apologies, IFRS 15. So now, what you're going to be asking yourself when it comes to 5-step revenue model, it will be a matter of performance obligation. What are the performance obligation here? The first performance obligation will be the shipping. Why we are saying it's a performance obligation, the shipping, it's because it is under CIF. And CIF means we're going to pay for transportation as well as the insurance. So now that creates a performance obligation on BK side. And the second part, or the second performance obligation, will therefore be avocado. So now that means now when you're looking at the step 2 model, you need to state, or you need to understand that there are 2 performance obligation, which is the shipping plus the actual avocado. And then when you're looking at step number 2 of IFRS 15, it's where you're going to be looking at the transaction price. Now, what will be the transaction price? So the transaction price might be a bit of a problem here. Why? Because the number of things that are happening. You have to consider International Accounting Standard 21, which obviously looks at the effects of the changes in foreign exchange rate, simply because they are quoted in the foreign currency amount. Then what you're going to be doing with regard to the price. So it means that you have to take into account adjusting this price to SA rand. And then there are things that might happen because of this amount was received in advance. It will be introducing significant financing component. However, because this will be during 1 year period, then what does it mean? It means that now we have to state that due to expedient in IFRS 16, we do not have to discount the amount that has been received in advance, because it's during the 12 months period, or will be received. Every amount for this contract will be received during the 12 months period, and the contract itself, it within the 7 months period. So that makes sense for you to understand. And then now, the other things that you're looking at now is the fact that there will be contract asset and contract liability. How is the contract liability created? Because when we receive this amount before we deliver the product that is worth this amount, we're going to be recognizing a liability until we satisfy the performance obligation, which is delivery of the avocado. Plus, after delivery of avocado has been considered, it will be your shipping of the avocado to the European company or Supreme brand. And then, how are we getting to a contract asset? The contract asset will be created if we have delivered everything, or from August, September, October, we have delivered the avocado. However, we've already satisfied the income received in advance that we have received. So that means now the supplier is owing us the money. Then in that case, now we have the asset. So now, just to summarize that, what you need to do then during the pre-release information, was expected of the candidate during the pre-release period. The candidates needed to understand 5-step revenue model, because they needed to understand how they're going to go about approaching everything on this sales contract with Supreme Brand. So if you went to the exam without knowing IFRS 15 revenue from contracts with customer, that would have been a suicide from you as a candidate, because that would mean it would be very hard for you to understand how you deal about those contracts in the books of the company. The second part, you needed to understand International Accounting Standard 21, the effect of change in foreign exchange rate. And the reason for that is because this contract is quoted in the foreign amount, which is the pound in this case. Therefore, you needed to understand how you go about converting that amount. And also the amount received in advance is also quoted in the foreign amount. Therefore, you need to know how you convert that amount. And the second part, which is, the third part rather, which is the standard that is normally not covered a lot in university, it's IFRIC 2020, which is foreign currency transaction and the advanced consideration. So you will need IFRIC 22 for the fact that you are looking at this advance payment, which is received in foreign currency, and also the extra amount will be received in foreign currency. Therefore, you needed to understand IFRIC 22. And then the other one that you needed to understand, which is the fourth one, is to understand the shipping term. The shipping term, you were already told on the information, on the background information, what does CIF mean? And they discussed that the CIF means that BK will be paying for the transaction as well as the insurance. However, the risk and reward will transfer at the port in Cape Town when the avocado are delivered to the customers in the Europe. And then the other one that you needed to understand, which would be you covering most of the standard that are applicable, would be your International Accounting Standard 37, that will be relating to the onerous contract. Why am I saying onerous contracts? Because this contract has fixed amount that BK will receive. So in case it happened now, because of the fluctuation and currency, BK is now receiving way less than what they would have expected to receive. Then it means that by delivering extra avocado, maybe in September to October, they are no longer making a profit out of this delivery, but they still need to deliver because there's a contract in place which they are committed to. So those are the most important standards that you needed to understand before you go to the exam. And when I'm saying understand the standard, you're only looking at the things that will be required for you to understand. You don't read the entire standard. For IFRS 15, you're not going to be reading the entire standard. You're just needing to read the 5 steps that you feel like are most important based on the information that is applicable to you. And same with International Accounting Standard 21, you just needed to understand how you convert the revenue and how you convert the liability, as well as how you convert the asset once you've started to deliver after you have utilized the entire amount that is given in advance. So that takes us to the end of document number 2. If you have any question regarding document number 2, please drop in the comment section. Then I will respond to you as soon as possible. If you have any question that you want us to look at, feel free to request me to look at that question. Then I will gladly assist you to look at that question with you. Thank you and enjoy the rest of your day.